2012, African-focused mining and metal deals made up 21% of global deals, with South Africa accounting for $8.5 billion of that deal activity. Joining us to chat about this further is Michael Bosman. He's a transaction advisory leader at Ernst & Young. Michael, thanks so much for joining us this afternoon. Well, I came across some commentary this morning. High-profile M&A activity in the US last week has livened up a worried market beset with Eurozone slowdown fears, debt drama and a looming US budget battle. What's the state of M&A activity in the mining sector specifically?
Well, thank you. I think the overall message from 2012 is that it was a very choppy year for M&A. It was certainly a down year by most indicators. By value, it was down about 36% year on year, and by volume, a smaller amount, by about 7%. So that's the global figure. So overall, there were about, in terms of the deals that we tracked, about $104 billion worth of transactions across around 940 transactions themselves. So that meant that it was down year on year, and also the average size of the deals was significantly smaller. And I think there are a number of factors which are driving that we can perhaps discuss.
Mm-hmm.
Michael, before we do discuss that, have a look at the big picture. You talk about 21% of the value of deals done in Africa, but are we fulfilling our potential? Let's say, for example, you took the amount of resources under the African soil and compared it with the other areas that you've surveyed. Would 21% be good or bad, if you see what I mean?
Relative to a tough market and a very patchy market, 21% is, we pretty much increased our stake from about 13% the previous year. So year on year, the African continent as an inbound destination for mergers and acquisitions activity was pretty flat year on year at around the $20 billion, as you say. To answer the question around whether or not we're fulfilling our potential, I think one needs to both unpack some of the specific issues that are very high profile and are much debated, certainly on your network, together with some of the broader trends that are affecting the overall mergers and acquisitions market. Because while clearly Africa is a relatively unprospected continent and certainly a source of many long life tier one assets over time, there are many constraints on getting those assets out of the ground, and there are many constraints on monetizing them. So we're not immune to both the logistical and infrastructure constraints, and obviously some of the political issues that I'm sure we'll touch on, together with the broader environment that is driving mergers and acquisitions globally in the sector.
Of course, while those constraints do stand and are well publicized as well, where do those drivers come in? What's acting as motivation in the face of those headwinds?
Well, I think it's fair to say that the African activity, if I exclude South Africa, because I do think that there's a specific set of discussions that we should have on South Africa, of the $20 billion, around $8 billion was accounted for by South Africa, as you rightly said. But of that $8 billion, around $5 billion was accounted for by a single transaction, which was the Anglo-American De Beers transaction. So if one strips that out of the number, you're getting to a level of South African M&A activity, which is around $2.5 to $3 billion, which is significantly down from the 13 odd billion that we were seeing 10 years ago. So it's been a consistent trend down in mergers and acquisitions activity, which you would expect. The South African market is a relatively mature market, and clearly the factors that are going to be driving that market are significantly different. When you look more broadly into the African economies, I think one can unpick several themes. So there's one theme around the DRC and the East African resources, particularly copper, and we saw a number of transactions in that sector. There's another theme around West African iron ore, and we saw a number of big transactions and a couple of big projects which have been put on hold in Guinea, for example. So I think one needs to unpack the specifics of both the commodity and the country risk in order to get a clear picture as to what the overall drivers are of the activity across the continent.
Mm-hmm.
And I think it's very useful to have a look at what's happened since 2008, the financial crisis, that is. And you highlight it here, I think, anyway, and you can correct me if I'm wrong, by saying a new class of investor has emerged. You say our analysis shows that the share of deal value by what you call non-traditional acquirers has grown year on year to account for 31%. What are you talking about when you say non-traditional?
I think that is a very, very important point, because what we've seen within the sector is that as particularly bank lending has pulled back from the sector, given the problems that you're certainly seeing in the loans environment, with many of the big banks pulling back their exposure. The non-traditional investors that we're talking about, I guess, would fall into 4 categories. The biggest of which, accounting for about 2/3, are state-owned enterprises, which are both Chinese and other Asian economies, Indian, Korean, etc., that where their drivers of transaction value tend to be securing access to resources, and there has been a maturing process around that. There's a second category of investors, non-traditional investors, which would tend to be the financial investors, so private equity funds, sovereign wealth funds, etc., and we're increasingly seeing their activity and interest in a number of these transactions. There's a third category, which again has been in the news, which is many of the commodity traders. So you will have seen increasing moves towards vertical integration from the Glencores, Vitol transactions, etc. And then there's a fourth category, which again is much smaller, but is worth a mention, which is some of the vertical integration of the specific manufacturers into fertilizers, etc., where they are securing the supply. So I think one needs to look at that in the round. But if you take the high-level picture, what is interesting globally is that between 2011 and 2012, the volume of M&A activity that is attributable to this non-traditional financing sector increased from about 21 to 31%. So it is becoming significant, even in a somewhat soggy and choppy market. In the African context, around of the 20 billion that we talked about, around 8.5 billion is attributable to these non-traditional financiers. Which again is interesting because, as I mentioned, if you strip out the Anglo-De Beers transaction, you're looking at about $15 billion worth of transactions. So our proportion is significantly higher, between 50 and 60%. And then obviously of that 8.5, around 5.5 was attributable to Chinese and Indian investors. So we certainly are seeing a significant and sustained level of activity from the state-owned enterprises securing supply for their production.
Of course, well, we've been looking at merger and acquisition activity. We're so focused on the investment side of things. We've got to look at the other side of the coin as well, where those disinvestments are starting to be made. I mean, what kind of trends are you noticing in that regard?
I think the most important trend, if I focus on the African story first, would be in South Africa. What we are seeing increasingly is a level of consolidation of assets, not necessarily disinvestment, but certainly consolidation of assets. And some of the biggest transactions we saw, so the Anglo-De Beers that I talked about, but the Rio Tinto purchase of the remaining stake in Richards Bay Minerals was another consolidation opportunity. So I think increasingly that's a trend that we do see and will continue to see, which is the consolidation of existing properties. And that's not necessarily just a South African or an African phenomenon. It is a global phenomenon as a number of the majors pull back from their more aggressive growth that they've been pursuing over the last 10 years through the super cycle. So I don't think it's specifically an African phenomenon. It's more apparent in South Africa because of the maturity of our market.
Let's have a look at 2013 now. You say again that the corporates are focused on cost reduction, also recycling capital via divestments. Are the non-traditional investors that you've been speaking about more intuitive and counter-cyclical? In other words, when the commodities are booming, the corporates say we've got to have a bit of the action, so let's pay up no matter what price. Are the other people that you've spoken of, the other entities, the 4 entities, are sort of waiting in the wings and saying, actually, we'll go in when the prices are a little bit cheaper? Is that a trend that might emerge in 2013?
I think it certainly is a trend, and we certainly saw it after the global financial crisis that you saw increased levels of activity, particularly from the state-owned enterprises, the Chinese businesses, into the resources. However, then a number of those investors, while they are picking up some of the slack, are not immune to the global pressures as well. We've seen increasingly a more commercial approach being taken by a number of the non-traditional investors. So return on investment, not growth or resources at all costs, is becoming a much more important driver of their investment decisions. But they are also modifying the way in which they participate. They're being prepared to take more minority stakes. They're being prepared to not just go for offtake agreements, but be in the asset for a longer period, understanding some of the maturity and the dynamics that are in what is incredibly a political environment. So yes, they're certainly taking up some of the slack, but not immune to the global pressures.